Israel and Iran have started a fight that, in practice, does not stay inside the borders. You are watching a conflict that can rewrite energy prices, currency values, interest rates, and your paycheck in the same year. And the painful truth is this: the same system that keeps you one emergency away from ruin is also positioned to profit when the world panics. This is not financial advice, this is financial education. I want you to think like an adult for once, not like a person who reads headlines and hopes reality will be fair. In 2026, you already know the pattern. You were promised that inflation would be temporary. You were told the job market would adapt. You were told housing would eventually normalize. You were told the stock market is the economy. And while you were being comforted with explanations, the mechanism kept running in the background, tightening the trap. So here is what we are going to do in this video. We are going to connect three things that most people refuse to connect: the timing of government debt rollovers, the way the world gets pushed into using the dollar, and how energy shocks do not just raise prices, they change the entire direction of capital.
Then we will talk about why gold in a crisis is not the simple movie you think it is. Finally, we will talk about what happens when the oil bottleneck meets a heavily indebted world that still needs dollars, right now, not later. And before you get comfortable, let me ask you a question you probably do not want answered. If a war can move oil prices fast enough to force central banks into decisions that destroy ordinary households, who benefits from that process? The answer is not the soldiers. The answer is not the people on television. The answer is the capital on the other side of the trade. Let us start with the part nobody wants to say out loud. Money is managed through deadlines, not through morality. In the last cycle, governments treated debt like a background hum. In 2020, rates collapsed toward zero. In 2021 and 2022, they pretended it was all under control. But by 2025 and 2026, the math got blunt. When bonds mature, governments do not get to ignore them. They must refinance. They must roll the debt. If they cannot refinance at cheap rates, they pay more. If they pay more, they print pressure into the system. And if they print pressure, inflation does not vanish.
It changes form. Now focus on the United States, because the United States is not just another country, it is the anchor for global pricing in energy and commodities. The Federal Reserve might not run oil, but it runs the cost of borrowing, and it runs the incentives for where capital goes. The key mechanism works like this. Suppose a large batch of U.S. Treasuries matures around a specific window, such as late spring into early summer. If the Federal Reserve keeps rates high, then new borrowing must be done at higher yields. That means interest expense climbs. Interest expense climbs, and suddenly the government has less fiscal room. It has more trouble funding everything at the same time: defense, healthcare, interest, subsidies, and the quiet obligations you never see on TV. Here is the part that should make you angry. When the cost of debt rises, the system does not respond by fixing the underlying imbalance. It responds by pushing harder on the same lever it always pushes, forcing demand for U.S. securities and U.S. dollars. You can call it policy, you can call it financial engineering, you can call it national strategy, but it is a lever.
And in the real world, forcing demand is not always done with speeches. Sometimes it is done with structures that make alternatives less convenient. Sometimes it is done through tariffs, sanctions, and trade pressure. Sometimes it is done through the simple fact that global payments still route through the dollar. Now let us bring 2026 into this, because you need the bridge between the abstract and your life. In 2026, AI is replacing middle-class labor faster than most people can process. You see it in hiring freezes, productivity reorganizations, and layoffs disguised as efficiency. You hear people say, "Learn to code," as if the market is still 2019. But in 2026, coding is not the fortress it once was. Tools generate working code. Systems deploy in days, not months. And even for the jobs that remain, wages do not automatically rise, because bargaining power keeps getting weaker. At the same time, housing has detached from wages in the United States, the United Kingdom, Canada, Australia, and parts of Europe. People do not move up anymore. They rent longer. They delay life milestones. They take on flexible debt and variable costs, and they call it adulthood.
Inflation may have cooled on paper, but real purchasing power never fully recovered for many households. And when energy shocks hit, that lost purchasing power gets assaulted again. So picture this. Your economy is already under stress. Your disposable income is already shrinking. Your mortgage rate or rent resets or climbs again. Then the world has a new energy scare. That is where wars become financial instruments, whether anyone admits it or not. And here is where the narrative gets ugly. People believe wars are about ideology. They are not. They are about leverage. Energy is leverage. Shipping lanes are leverage. Control of choke points is leverage. And when those leverage points move, capital reallocates instantly. Now, you might be wondering what Israel and Iran actually have to do with your gas bill or your grocery bill. The honest answer is everything, because energy is a global bloodstream. If a major conflict threatens supply routes, the price of oil jumps. Not slowly, quickly. In the original scenario, the claim is that oil prices spiked by roughly 36% in a short window when the tensions escalated. I am not here to pretend that exact number is guaranteed minute by minute, because markets can move in both directions. But the mechanism is real and repeatable. A credible threat to supply creates a fear premium. Fear premium means prices rise even before barrels actually disappear. And in the background, you have the dollar demand problem. Energy gets traded in dollars because decades of market structure and debt pricing make it so. If you want oil, you need dollars. If the world is short dollars, it does not just mean oil costs more. It means every downstream system has to find dollars to pay for imports, to pay for logistics, and to service debts. So let us talk about gold, because everyone has heard the movie version. In a crisis, buy gold. Wars make currencies collapse. People carry gold like it is a lifeboat. But real data tells you that this is not a magical button. In recent major conflicts, gold did not simply surge for 4 straight years. It dropped hard during multiple periods, even while risk increased. Why? Because when panic hits, capital flees to liquidity. And in modern markets, liquidity often means US dollars first. It means short-term instruments, it means cash-like assets, it means whatever can settle quickly. Sometimes it means gold later, sometimes it means dollars the whole time, and sometimes it means the spread between what people believe and what the market actually does. Now, bring 2026 back again. In 2020, people bought gold and cryptocurrencies as hedges. In 2022, people saw the war headlines and assumed it would be a clean gold rally. But the dollar does not always cooperate with gold narratives. When yields change due to the Fed, investors can prefer Treasuries over gold even during turbulence. When energy spikes, the immediate question is who can pay for imports right now, not who has the best long-term story. And now you see why the buy gold blindly in a war advice can be a trap. Wars do not produce one-directional flow. They produce forced liquidations. They produce margin calls. They produce asset rotation. Sometimes the asset that survives the panic is not the one you bought for the correct reasons. It is the one that fits the market's need for liquidity at that moment. So what happens if gold rises strongly? In the simplistic version, you feel safe. In the real version, if prices rise quickly enough, the world can spend down reserves to acquire it. Central banks might buy gold, yes. But the broader effect is that the dollar reserve system becomes more complex. Investors and institutions can shift portfolios into gold while still needing dollars for energy. That creates a nasty feedback loop. If gold is expensive and you need dollars for oil, you may be forced to sell gold to obtain dollars. Then you buy oil, and then gold can drop. This is not a conspiracy. It is basic market behavior under constraints. So now the question becomes, what is the actual constraint? In the scenario being discussed, it is the Hormuz choke point, the narrow maritime route through which a large share of global oil shipments must pass. Here is the blunt reality. A choke point is not just geography. It is a throttle. It is a switch that can suddenly limit the flow of a vital input. If that throttle is threatened, even countries with domestic supplies face price increases because global pricing and shipping insurance adjust instantly. Now imagine 2026 Europe. Europe already faced energy volatility during the earlier Russia and Ukraine period. Insurance markets became more expensive. Shipping costs rose. Some households reduced consumption. Some industries paused investment because energy costs ate margins. That pain never fully went away, it just became part of the new baseline. Now imagine 2026 Asia, where demand for energy still rises with industrial activity and population. If the choke point threatens, the price of oil affects everything. Fertilizer costs, logistics costs, food costs, manufacturing costs, and transportation costs. And then you get the economic term that sounds academic but feels like a punch, stagflation, and sometimes what people call stackflation, meaning both slow growth and sustained price pressure. It is not a textbook nuance. It is the feeling of paying more while earning less. Now you need to understand why central banks can struggle in that environment. In normal inflation, you raise interest rates to reduce demand. In energy-driven inflation, raising rates can crush businesses that are already squeezed by input costs. If energy prices spike, companies do not have demand, they have cost. Higher rates reduce credit availability. That can increase bankruptcies and layoffs. So you can end up with unemployment rising while prices stay high. That is the trap. In that trap, governments often do not solve the problem with elegant policy. They solve it with money creation and debt restructuring by stealth. They try to keep the system from breaking while they quietly shift burdens. And in a world where the dollar is still the dominant reserve and pricing currency, the United States can sometimes export pain more efficiently than others. But again, do not confuse exports of pain with fairness. Exporting pain still destroys lives. It just destroys different lives in different places, and it does it with paperwork instead of bullets. Now let us zoom into the part that connects directly to your retirement and your job security, because that is where the dark truth becomes personal. In 2026, retirement systems are underfunded across many countries. Pensions are fragile. Social Security in the United States has long-term pressure as demographics worsen. The retirement age gets pushed back again and again, and people are told to plan better. Meanwhile, AI and automation reduce wage growth for many workers. Meanwhile, stock markets keep rising at times, but the wealth gains concentrate at the top. And when energy shocks happen, the poor are affected first. They spend a higher share of their income on essentials. They have less buffer. They do not have portfolio rebalancing skills. They do not have a fund manager. They have a landlord, a car loan, a pharmacy bill, and a pantry. You see this when oil spikes because transportation costs rise. When fuel rises, delivery costs rise. When delivery costs rise, food prices rise. When food prices rise, everything that relies on stable food supply rises. Then inflation becomes a lived experience again, not a statistical concept. Now, here is the cliffhanger that most mainstream commentary avoids. When the world needs dollars to buy oil, the demand for dollars and dollar assets changes. That demand can change yields. That can change bond markets. That can change the cost structure for governments. It can also change the incentives for the Fed. So the Fed might look like it is just setting interest rates, but interest rates are a throttle on the cost of global capital. If global demand forces dollars into the market and into safe assets, then yields can fall even if the Fed wants them high, or yields can remain unstable. Either way, the system becomes more dependent on dollar liquidity. And in that environment, the United States has a unique advantage. If global capital needs dollars and the safest place to park dollars is U.S. Treasuries, then the United States can attract buyers for the debt. It can refinance. It can continue funding. It can delay painful reforms. That is why, even during periods where the government's fiscal position looks ugly, the market can still buy the bonds, not because people suddenly trust politicians, because the market needs the instrument, because oil and trade still run through the dollar. Now, you might think that the endgame is straightforward. If bonds become too expensive, defaults or forced inflation happen, but the United States can also tighten and relax policy strategically to manage the timeline of debt rollovers, and that leads us to the real rich get richer part, the part that makes the system feel rigged. In this kind of scenario, energy prices rise. That benefits oil producers, energy traders, and energy-linked financial assets. Meanwhile, other sectors take hits because input costs rise and demand becomes weaker. The question then becomes, where is the production base? Many people assume that Middle Eastern producers cash in while others just watch. But the United States is also a massive producer and exporter of energy, including refined products depending on the year and the market dynamics. That means the United States can benefit both as a seller of energy and as a buyer of global assets with dollars. And then you layer in something even more important for 2026, industrial policy and onshoring. In 2018, 2019, and early 2020, many companies moved production for cost reasons. Labor was cheaper elsewhere. Supply chains optimized for efficiency. Then geopolitical stress, tariffs, and pandemic disruptions broke that illusion. Now the dominant strategy is reshoring and friendshoring, but it is expensive. You hear politicians talk about moving factories back to the United States. That is not a charity project. It is expensive. Building factories in the United States can cost several times what it costs in countries with lower labor and compliance costs. So how do you make it happen? You do not make it cheap. You make it urgent. If you raise energy costs and shipping costs for the rest of the world, and you apply trade pressure, then it becomes rational for some firms to relocate. Not because America suddenly got efficient overnight, because the rest of the world got more expensive to operate in. That is the mechanism described in the scenario. The combination of currency pressure, tariffs, and energy choke points can make global production costs rise relative to the United States. Then companies that want to avoid tariffs or export restrictions can move. Then industrial employment might increase in certain regions. Then politically connected firms gain subsidies and procurement advantages. And then the capital flows concentrate further. This is why the dark truth is not merely that wars are bad. It is that wars are profit opportunities inside a system designed for capital. Now let me bring you one micro story so you can feel it instead of hearing it. Picture a supply chain manager named David. He is 38. He works for a mid-sized manufacturing company in the Midwest. 2 years ago, he was told automation would make his team more productive and his job would become more strategic. Then he watched a competitor replace an entire scheduling department with a planning software system powered by machine learning. David survived barely. Then his company started paying more for shipping because fuel went up. Then costs rose for parts sourced from overseas because energy costs increased in the supply chain. Finally, sales slowed because customers pulled back. David does not care about geopolitics, he cares about margins. But the margins collapse anyway. His company freezes hiring. He hears rumors about layoffs. He checks his retirement accounts, hoping the market's optimism will balance out the anxiety. Then his rent rises again at renewal because landlords reset costs to reflect inflation and financing costs. David is not living inside a spreadsheet, he is living inside a sequence of bills, and by the time he understands that oil and interest rates are connected, the opportunity for adjustment is already gone for him. This is what the wealth gap looks like at human scale. While David tries to survive, the capital holders can adjust positions faster. They can hedge, they can earn from energy volatility, they can reposition into assets that behave differently under stress. David does not have that flexibility. Now, do you see the pattern? It is not that the market is evil, it is that the market rewards speed and constraints, and it punishes those without buffers. Now we come to the darkest understanding, the part that most people refuse to accept because it breaks their faith in fairness. When the world enters a period of energy-driven inflation and debt refinancing pressure, the system can decide to manage the damage through global asset repricing. That means asset prices and currency values can shift. That shift can reduce the real value of debts for governments and households depending on timing. It can also concentrate benefits among those who hold the right assets at the right moment. In earlier periods, the United States has relied on inflation as a quiet debt solvent, not through dramatic announcements, through the slow erosion of purchasing power. In the scenario, the claim is that if inflation reduces the dollar's purchasing power by, say, 30% since a point in time like 2020, then the real burden of debt looks smaller in purchasing terms. That is the logic debt holders understand instinctively. Borrowers are happy when inflation outpaces wages. But now you have a global debt crisis too. Global debt levels exceed $300 trillion. That is not a small problem. That is a structural fragility. When inflation returns and growth weakens, debt becomes harder to service. That increases pressure for refinancing. It increases pressure for policy intervention. And if intervention comes through printing money, the dollar's value can wobble while still remaining the center of trade. This is the irony. Even if the United States prints, the dollar might not crash instantly if other currencies are also being weakened. If everyone is inflating, exchange rates can look stable while purchasing power still declines. So the United States can maintain relative advantages in trade because the dollar's role is entrenched. Now here is the cliffhanger. If that process accelerates during a crisis, then the winners are not the people who guessed the right asset. The winners are the people positioned at the center of the mechanism that converts geopolitical stress into financial transfers. In 2026, that includes energy-linked investors and institutions. It includes asset managers whose clients can rebalance quickly. It includes banks and funds that can borrow cheaply and move aggressively when volatility spikes. It also includes governments that can coordinate fiscal and monetary policies faster than households can coordinate their budgets. So where does this leave you? It leaves you with one